Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Now, consumer price inflation has risen to a 22-month high of 5.77% in June 2016 compared to 5.76% a month ago. But the figure looks a little starker if compared to March or 3 months ago when it was below 5% at 4.83%. Now, higher food prices are the key reason, even as the weighted contribution of vegetables has increased from 1% in March to 17% in June. The questions we're asking is, are we losing control of food prices, and if so, what could happen in months ahead? And more importantly, should the Reserve Bank of India be responding with an interest rate move at this point? To discuss this, I'm joined by Anish Chakravarti, lead economist and partner at Deloitte, Upasana Bharadwaj, economist at Kotak Bank, and Sujan Hajra, chief economist at Anand Rathi. Thank you all for joining us. Anish, let me begin with you. What's your sense? Are we in a precariously positioned point right now, or are things under control?
I think there are some reality checks which need to happen at this point of time. So if you look at the RBI anchoring, I think that needs to be reworked now, given the situation we are seeing. I just want to react to something you said earlier, which relates to the food prices itself. I don't believe that we were ever in control, because the way food prices have marked out in India over the last 5 to 10 years, it is not an inflation problem, it's a supply chain problem in my mind. And unless we sort out supply chain inefficiencies, which the government is trying, we will, in my mind, not have control over the food inflation aspect. Typically, if you look at the situation of pulses, vegetables, I mean, we've been hearing of vegetables for the last 4 or 5 years, right?
But pulses have been coming down.
Pulses have come down, but sugar, for example, we've turned net importer. The government is thinking of the import on raw sugar, the import duty on raw sugar. So these are areas where we think we need to iron out much more till we get some grasp on food.
So what explains then the downward movement at points like it was maybe a few months ago and then an upward movement again?
So a lot of it is linked to rainfall, for example. So we had a deficit in the earlier month, and that has picked up. So we have a surplus now. Southwest monsoon is doing well. So a lot of it is linked to those short-term movements. But if you look at the overall trajectory, I think from my perspective, unless we have control on food, on agriculture itself, on the output, on supply chain efficiencies, APMC strike, for example, I mean, these are control issues. This problem will persist.
Okay. Sujan, is that something that you concur with?
No, I actually have a diametrically opposite view in the sense, like if you go back 3 years, the kind of food inflation we were and the situation now, it's drastically different, and that's despite you having 2 bad monsoons and actually 2 bad ravis also. So in that sense, there has been a very significant improvement in the supply chain that's pretty apparent. But having said that, if you see globally, you talk about core and non-core. The basic reason you distinguish between core and non-core is food or fuel is the volatile component of inflation, not only in India, everywhere else. So in a sense, I'll say while the picture is not looking particularly good over the last 3-4 months, but on an overall basis, we have got a better hold over inflation, including food inflation.
Right, so core is constant is what you're saying. But if I look at the components of core, clothing, housing, tobacco, intoxicants and so on, I mean, that is unlikely to move in any case, right? Should we be taking, should we be deriving comfort from that?
It's not a question of comfort. The fact of the matter is that you see your both core and non-core has fallen. If you see the trajectory, slightly longer term, so you can derive some solace out of it. I'm not telling that you have fixed the problem once for all, but having said that, we are in a better position today than we are 2 years back.
So let me get another view. Upasana, what's your sense? I mean, and let's ask that more fundamental question: are we in control of food prices and food inflation? Do we have a sense of which way things are likely to go?
To an extent, I would partly agree with both the other panelists. For food inflation, we are heavily dependent on rainfalls for sure. So that is the reason why we tend to see the huge swings every now and then. Every year we await for the rains and we hope that things are going to be better. And given that we followed with 2 or 3 years of bad rains, and this year hopefully when rains are seeming to be good as of now, we should be seeing some food price pressures abate for sure. That is one thing, but on the core inflation side, we are not really expecting too much of downside to inflation. There is a lot of stickiness, downward stickiness to inflation, and we don't really expect that to really, improve, or food price pressures to really come down on that front. So core inflation is something which we do not really expect much to happen. But yes, on the food inflation, the supply chains problems have to be addressed. There is no denial of that. And without they being addressed, we will continue to depend on rain gods every year. and that swing is likely to really make it very, very challenging for the RBI to really make decisions going forward. So definitely, while we do expect that in the coming months, the food price pressures will abate. Maybe 1 or 2 readings will be as high as what we've seen recently, and after that things should improve. But having said that, this is relief we may get, and every year we may be faced with the same challenge. So the supply disruptions that have happened and the supply chains that need to be built have to be worked on. Definitely the current government is attempting to work towards those, but yet we have to go a long way ahead.
Okay, Sujan, let me come back to you. So if we were to, sort of try and look forward now, what should be the response? I mean, are we looking at monetary, fiscal, supply chain? I mean, in the immediate, and then we'll talk about the longer term.
See, the only monetary response you can have rising inflation is rising the rate. That's obviously not a possibility. But
why is that?
See, the point is that the effective cost of fund is already high. The monetary policy cuts haven't got transmitted into the effective rates. So I don't think there is a possibility of a rate hike.
Okay.
At the same time, so the impact, so it has to be.
But it's also negating a rate cut in some ways. I mean, if you're saying that.
Yeah, in a sense, in real terms, it's actually. But having said that, the only thing you can do is a better supply chain management. Say, for example, sugar is a case in point. You might have to increase import, but having said that, India is a big. If India enters the international market, and these markets are extremely liquid, that impacts the international price as well. But having said that, better distribution, for example, on the APMC, the move is positive if you cut down the middleman. Obviously, there will be softer prices. In fact, if you look at the tomato prices in Bombay, it has come down from 180 rupees to 40 rupees within a span of a week. I'm not telling you it's all because of APMC. The kind of hoarding and all those things, this has manifested in a
right. So you're saying supply chain inefficiencies, the presence of the middleman, at least in the case of Maharashtra. Okay. So let me come back to you, Anis. So one of the things that's perhaps a little unusual is the fact that service inflation has really not moved, and actually in some cases it's gone downwards. Now, also, I mean, this is a larger data question. I mean, is all the data appearing as kosher it should be?
That's a loaded question. I mean, there is always question on data. We've seen, number of years onwards that data has been questioned. Some data is definitely difficult to explain because there are contradictions that we see. Some data gets smoothed out over time when there's a revision that comes out. But just on the service inflation point, I don't think at this point much has happened on the service side, in my view, which warrants a significant amount of, let's say, worry on the service inflation aspect. Okay. Because if you look at some of the key elements, so food is one, of course. We've spoken about core. Then you have miscellaneous. We must remember a lot of petrol, diesel, all that comes into the miscellaneous, not in fuel. Fuel has actually remained constant, I think about 2.92. Yeah. So it's slowly going down. The worry then comes on the other aspects, which is housing. And you mentioned housing as part of core. And I have a view on housing because that is one aspect where going forward, not in the short term, but I think in the mid to long term, I would see some upside risks at this point of time.
Okay, right. So the other point you talked about, which could affect inflation in the way it goes, is the pay commission and the people obviously getting paid more and collecting arrears. What's your sense? And let me get both your views on this.
So my sense was, I would think that was a much higher risk in the month of April if we were having this conversation. At this point of time, the way it has happened, I think it's slightly watered down. Because if you look at the 14.29% that we're hearing about, the fact that HRA, dearness allowances, all this is not going to be part of the first phase, means that delta that we looked at in terms of extra funds or cash in hands of, let's say, a number of the populace, that probably goes down. Which means that over the medium to long term, that risk definitely remains. But it is muted in my mind from an effect perspective.
Right. So, Sujan, extraneous and intraneous aspects that could have an impact on inflation in coming months.
Just to coming back to the pay commission effect, there are two effects. One is the technical effect. For example, the housing rent, which is calculated only for urban consumers, that's linked to the HRA given to the government employees. So, as and when the HRA rises, technically that part of the inflation will go up. But the other impact, which is the real impact, the increase in consumption. Now, if you look at the overall payout of the pay commission, even if the pay commission's recommendations are taken as it is, I don't think on the park side it will be taken as it is. It's a lakh crore. That's the gross amount. And if you look at the overall private consumption in India, it's in excess of 70 lakh crore. So you are talking about 1.5% of the consumption being impacted. So I don't think pay commission itself has a big impact.
And that's a useful figure to look at in perspective. Right. Okay. Upasana, can I get a last word from you? So what's your sense? What's your outlook going ahead? And are there any concerns that you would flag off? Or perhaps on the other side, with a good monsoon, maybe some positive factors?
Yes, monsoons is definitely a positive factor. But I think one point I wanted to highlight is the rural and the urban inflation gap that we have. And that's where I'm finding a cause for worry, because the rural inflation is consistently up. And again, the supply inefficiencies come into the picture, because it is the fuel category, which is fuel along with the clothes and the miscellaneous, all others except for food, which is actually showing a wider divergence. And with rural inflation consistently remaining up, even though the headline inflation is closer to RBI's comfort trajectory, we will definitely at some point face very severe challenges to our medium-term target of 4%. So clearly the supply side issues, the transport connectivity to the rural areas need to be addressed before we can really think of achieving a medium-term goal of 4% in the next couple of years to go. So forward looking, if I was to look at just FY17, yes, things look comfortable. We should be, if the technical aspect of the HRA component because of 7th pay commission is not implemented this year, we should be looking at closer to 5% by end of the year, which should probably provide some comfort to RBI. So eventually we are expecting some kind of monetary response, probably 25 basis of a rate cut. But not in the upcoming meeting in August.
Let me get a last word. You two wanted to weigh in on the difference between rural and urban inflation quickly.
Yeah, see the difference mostly it's because of the weightage of food in rural and urban. But having said that, if you look at the different commodities are moving very differently. For example, if you look at the pulses inflation in rural India and pulses inflation in urban India, it's coming down in urban India, it's going up in rural India. Similarly, if you look at sugar, so quite a few of divergent trends is there. Having said that, even outside food, there is significant difference in fuel.
Right.
That's basically the kind of fuel you use.
So what should we be, I mean, is that something that we should be just watching? Should we be reacting?
To some extent, you have to react. For example, the revision of kerosene prices recently, and kerosene as a fuel is more a rural fuel. So obviously, which is already high, the rural fuel and light is already high. It will go up further. So there has to be some calibration of this thing, because ultimately inflation will impact the unindexed part of the labor force, and most of which live in the rural areas.
Right. We've got to end there. Thank you so much for joining me. We need to go in for a break as well. Coming up on the other side, the markets are looking very strong. There might be opportunities in that, including for the government. Stay with us. Welcome back to Policy Watch. Global and Indian stock markets are roaring ahead with no seeming concern for a whole host of negative factors. The BSE Sensex has reclaimed the 28,000 mark, and on Wall Street, the Dow Jones Industrial Average and the S&P 500 have hit record highs. Now, so what's driving this relative euphoria across markets despite the fact that Brexit, or the British exit from the European Union, is yet to play out? There is an Italian banking crisis now looming on the horizon. So how is all this affecting Indian markets, which too are shrugging off negative news, for example, rising inflation levels? More importantly, is this an opportunity to raise capital to power India's infrastructure and other needs? And finally, what are the concerns, if at all? To discuss this, I'm joined by Sudeep Bandyopadhyay, Chairman of Indie Trade Capital, and Ashish Kayal, Founder of Wave Strategy Advisors. Gentlemen, thank you both for joining me. Sudeep, let me begin with you. If we were to look at the sudden sort of buoyancy in the markets, what explains it?
Well, I think one word will explain. That's liquidity. I think global markets is flooded with liquidity. Japanese central bank is injecting fresh liquidity into the market to bring buoyancy in Japanese markets. US, where there was an expectation of maybe a rate increase, I think that's not going to happen, because US policymakers are worried about the impacts of Brexit, and I don't think, in spite of good job numbers, they are going to raise interest rates in a hurry. So overall, I think there is a risk-on mood, and which is being supported by a huge amount of liquidity, both in Japan as well as the Western world, which is US and Europe. This entire liquidity is chasing the stocks in markets like India, and that's pretty much the reason for this kind of a buoyancy which we've been witnessing in the market. bit of a concern, of course, because I don't think the valuations are looking too good for an investor with a time horizon of 1 year plus, because I think they have run well ahead of the earnings. And
that's also happening in the US.
Yeah, it's
right.
pretty much happening all over the world.
Right.
So I think we'll have to be a little cautious, because as you rightly said, Brexit hasn't played itself out, and you're absolutely right. People are ignoring the Italian banking crisis. It's a huge problem. And remember, it's not Greece. Italy is a large economy. They are probably third largest economy in the EU today. So we have to be extremely careful. The situation is extremely volatile. So just because of the gush of liquidity, they're chasing the stocks and it's going up. And if we fall prey to that and start buying stocks at such a high level, I think it's a recipe for disaster.
Right. So you're saying this should be concern for investors, particularly smaller investors who might feel that this is a one-way street, as they usually do. Okay. So what do you feel, Ashish? What's your sense? How are things looking on the charts, and what is this telling you?
See, overall, as it is rightly pointed out, there is a lot of liquidity that has been chasing, and if you look at Dow Jones Industrial Average on the charts as well, it formed a major low in 2008. So it was already in the bull trend, and the Brexit event came at the point when the markets were already moving higher. So the sentiments had been positive. So there was a lot of quantitative easing which was done in 2009, 10, 11, and that has led to the positivity in the sentiments, which is driving it right now on the higher side. So I would also say that it's not purely because of the fundamental reasons that the markets are moving higher, but it's more of the sentiments and liquidity that is playing it higher. And at the same time, Dow Jones have been moving higher. It's not only US markets, but even FTSE. If you look at the charts, on the Brexit day, FTSE did not make a fresh low, but instead it recovered back sharply after a few days and is trading at it's about to touch the previous highs as well. So all of these are indicating that it's more of liquidity driven and not about anything fundamental or rational that looks to me right now.
And are you seeing a direct correlation or almost direct correlation between what happens in the Dow Jones and let's say the BSE Sensex?
I would not say that the correlation is very, very strong, but definitely there is some kind of a positive correlation which we can see, because when the US markets, Dow Jones, S&P are hitting lifetime highs, that sends across a signal that there is still a lot of liquidity which is driving them, and that liquidity can come to India as well. So it helps these sentiments, but definitely there is not one-on-one correlation which we can see, but definitely it helps the sentiments.
So we'll come to how this could be an opportunity as well. But before that, Sudeep, what's the flip side of it? So liquidity could continue to flow, right? It may slow down. And are there any indications that could cause that reverse, particularly in terms of interest rates?
So I think a couple of things I'll say, if you're talking about the overall markets, I think the fundamentals of Indian markets were strong. We must remember that, and let's we should all be happy about it. The macro factors for which we were all worried about are falling in place, whether it's a monsoon, whether it's the regulatory reforms or the executive reforms. All this is happening. Corporate fundamentals also have significantly improved. Last quarter was a pleasant surprise for all of us. Nobody expected corporates to perform as well as they did, and we'll have to see how this quarter pans out. But I think fundamentally India was doing all right, and valuations were already inching up. Then the gush of liquidity came, and the risk on mode for the foreign institutional investor, and that took the market to a different high in spite of the negatives which are prevailing in the the global economy. So our sense is that we need to be a little careful. We also feel that maybe a couple of quarters down the line, if corporates continue to perform, probably these valuations will look realistic. But I think we are moving a little ahead of that. And that's the worry.
Right. So, and between global liquidity and domestic liquidity, how much is powering the market to what extent?
Well, I think, Govind, it's more of the mood. Because of the liquidity, the foreign institutional investors are in a buoyant mood. They are putting money behind equities and all asset classes. And remember, it's not only Indian markets. Pretty much all the emerging markets are getting huge amount of liquidity from foreign investors. Now, when market sees this kind of an upward movement, domestic investors also start participating. If the market is moving, why not? If the party is on, why not be there? So they are also participating. Now, when the music stops, that is when the liquidity, there is a sign of liquidity not being there, or when there is a risk off. The moment that happens, I think we will in for a rude shock. I'm not saying market, the bottom will
But is
disappear.
is that what history tells us? I mean, liquidity flows tend to dry up suddenly?
Absolutely. I mean, I'm not saying it will dry up to an extent that markets will go back to 7,000 levels. Not that. But the reality is, the moment there is a trend reversal, markets will in for a shock.
Okay.
And that shock can take down market by 300-400 points.
Right. So, Ashish, are you seeing do you foresee a trend reversal in turn because liquidity could get dried up or some other extraneous factors?
Yeah, see, the concerns still remain. One is that major tops in the markets are formed not because people start selling. It is formed because there is no one left to buy. So if there is no one left to buy, then the market suddenly starts reversing and falling very sharply. And what happens, people have a tendency of herding mentality that's normally followed in the markets. So when the prices were at lower levels just about a few months back, no one wanted to buy in equity markets. And now when it is reaching around 8,500, 8,800, everyone want to be a pie and of the growth story. So that is definitely concerning. And what concerns me more is that the inflation which was expected to pick up in the Eurozone, in US market, has still not picked up. Many of the developed economies, if you check, are still exhibiting negative yields or almost zero yields. So those are also concerning signs. And at the same time, this time the rally which has happened because of the buying in the PSU banks. Now there is a very typical behavior. PSU banks have corrected sharply from their highs,
right.
And if you check 2008 highs are still very far away. And the bounce back which we are seeing is probably a retracement in PSU banking sector, metal sector, which was already oversold. And Brexit provided that trigger where people thought, okay, let's buy, and these are the sectors which were out of the flavor, suddenly became the theme of the market. So there is a retracement which is ongoing, and definitely there is a concern.
Right. Okay. So Sudeep, if we were to see this as an opportunity, because liquidity is also good because this is a good time to raise funds, how would you say we approach it, and how could there be a policy response or
Absolutely.
to it?
Yeah. I think you're 100% right. I think it's a great time to market some of the issues or some of the disinvestments which the government has been talking about for quite some time. So look, we should come out with a public issue or a strategic sale or any kind of disinvestment, divestment at a time when there is enough liquidity, where the investors are bullish. I think this is a great time for doing that. Look at the masala bonds which HDFC came with and it got subscribed. Look at the IPOs, the way they are getting subscribed today, the kind of oversubscription they are attracting. So the government needs money, obviously, to balance the budget. There is a target for disinvestment. I think it's the absolutely opportune time to come out with those disinvestments, whether it's a strategic sale of Suti we are talking about. All that should happen within the next I would say tomorrow.
Yeah, yeah. I was actually going to ask you about the window. I'm saying, what is the kind of window that we have, particularly if you want to look at big fundraising?
Well, Govind, one can never be sure, but I think this kind of euphoria can last for about a month and a half more, because the way things are, the pain of Brexit probably will somewhere start emanating itself in about a couple of months' time. Italian situation may suddenly.
And you see Brexit sort of coming back to boomeranging or whatever. If you want to use that word, back
that's
on
right.
us.
That's right. So
I
won't say it's not boomerang on us, but it'll boomerang on the markets. Because markets have completely discounted it. It's not an event which can be completely discounted. It's a matter of huge concern. The world is changing, and we have to be cognizant of that. So coming back to the point, I think 1.5 months is the time window we have for doing this fundraising. I'm not saying fundraising will not happen after that, but I think this euphoria is a great time for government to attract money
and get going. Last word.
Yeah, so what I would suggest is that the euphoria right now which is ongoing is actually the best time, as rightly pointed out, because a lot of people try to put money during the euphoric times, and that helps IPO to even list at a very, very expensive pricing, so which helps the investors to get out. That's one. Secondly, a lot of things are changing. Definitely one concerning point is that the FTSE has moved higher. However, you look at the other markets of the Eurozone, which is DAX, which is a Germany market, one of the strongest economy, that DAX index is still not filled in the gap during the Brexit event. If you look at CAC, it has still not filled in the gap. And the other major concern that everyone is ignoring is the sharp appreciation seen in GBP, in INR against GBP. So that sharp appreciation is going to hit anyone who has exposure to UK. So those currency appreciations yield and and the Eurozone are definitely concerned, but the buying opportunities will be there. Eventually, any correction will provide buying opportunity later.
Broadly, you're saying, do you agree with the window? I mean, is that
yes,
yeah? Okay.
Yes, absolutely. So I think the liquidity might dry up suddenly over the period of next 2 weeks or 3 weeks, and the entire pattern we have seen is in an overlapping fashion, which is concerning. So if that happens, then we might see a very
short
sudden
window. Therefore, we must move quickly, and that's really the moral of the story. Thank you both for joining me. We run out of time. That's all we have time for on this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.